Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Hi there, and welcome back. Boy, we have a special show for you today. Welcome to the Real Estate 360 program, your number one source for all of your real estate needs here in the Bay Area, where we provide you with the information you need to make the best fact-based decisions. Real Estate 360 runs once a week on the Monday through Friday at 3 p.m., and it's with my co-hosts, Joe Kuchera and Lori Graymont. If you don't catch us there on live, you can certainly go to our website, which is RE360radio.com, or you can catch my programs on my website, TomWilsonProperties.com, or go on iTunes. So it's every day of the week with different guests and different topics. You can go on my website, TomWilsonProperties.com, and get a weekly economic newsletter that sums up what's important in the economic world relative to real estate. That's a once-a-week, 1-minute read, which helps you make it through all of that world of data we have out there. Also have a report that you can ask for that is a 19-page report, very fact-based, that talks about how to select the best metro and the best product for real estate investing. And always, we welcome your questions, welcome your suggestions for topics and guests. So today we have with us Richard Smith, who's a longtime friend, been my accountant for 27 years, and he's going to talk to us today about tax planning and what you should do about it. Don't touch that dial. This is a very important, very informative session. You know, most of our education-based real estate programs are not very time sensitive, so that you can go listen to them at any time and come away with information. This one is a little bit more time sensitive, but many of these items will apply to many different time periods. But we're going to talk about planning, things that you can do before the year's out, and what you should do in planning for your year coming up next year. Richard Smith is another one of those engineers turned into the real estate world. He was 15 years with IBM, 30 years as an enrolled agent and accountant with Richard Smith and Associates, 40 years as a real estate investor, bought and sold Lord knows how many properties, and holds over a couple hundred properties today, and probably over half of his several hundred clients own real estate. And I've always told you that when you go find a professional, you want to make sure you find someone who's experienced in that very specific area that you need assistance in. So if you're a real estate investor, you want to have lenders, you want to have tax professionals, attorneys, so forth, that are specialized in that particular area. So Richard, welcome back to the show.
Thank you, Tom. Looking forward to it.
We got a lot of material to cover, so let's jump into it today. And I think the first thing that we'll talk about is a topic that's very popular, but amazing with all the discussion there has been about Obamacare and the Medicare tax. It still is very much a mystery, I think, to many people. Wouldn't you say? I
would agree. You know, when you look at Obamacare, and I've spent quite a bit of time, because its impact for 2013 is major, and a lot of people don't realize. And the question always becomes, how do you pay for this product that they've been building? And so they've invented new taxes to help pay for it, and we'll cover that this morning.
Okay. So let's just summarize from a general impact what Obamacare is, how it's going to change people's lives. What are the requirements, and then let's talk about the impact on the tax part of Obamacare.
Well, starting in 2014, everyone must have medical insurance, and we'll talk a little bit about that later, because some people have already chosen not to pay for it because you've heard the premium increases that a lot of people are facing. But the question always has become, how is the government going to pay for it? So they invented new taxes, and the income tax that has been generated, some people call it a Medicare tax, some people have called it a sales tax, and there's a lot of items on the internet that are not true. So what they're basically doing is a new 3.8% tax on investment income. Now, it's already taxed once in your ordinary tax return, but now we've got an add-on tax called an investment tax. And so if your income exceeds, gross income we're talking, not taxable at this point, but if your gross income exceeds $200,000 if you're single or $250,000 married, then the government's going to charge an additional 3.8% tax on interest, dividends, capital gains, rental income, and passive income from partnerships and sub-S corps and activities that you're not active in. Well, it doesn't sound like a lot, but remember it's based on gross, and it's already been taxed once. So now the question is the government going to tax us again on it? And we have a lot of our clients who are real estate professionals who make a living just from their real estate, and the government has already decided, the IRS decided that those will be taxed as an additional add-on tax too. So what happens? We look at the person's income. Say, let's take a single person. Suppose their gross income
let's walk through an example
is $200,000, and let's suppose that their investment income from interest, dividends, and capital gain was $25,000. So when we look at that, we have to determine if they're going to pay, what amount of tax they're going to pay. So in this case, their combined gross income is $250,000, of which $25,000 is investment income. Well, their threshold is $200,000.
And that's for a single.
For a single person, $250,000 if you're married. Now, if you're a married person, you'd pay no additional tax. This person is single, so the question becomes, they're going to pay an additional 3.8% on the $25,000 of investment income. So not a big number, $950. But in planning we've done for some of our clients, we had a client recently came in, didn't think he had much of a tax problem. We took his 2012 income, looked at his taxes for 2012, took the same income. Most of his income comes from rental income, and we used it on our 2013 tax rates. His taxes went up 20%, $50,000. He was really, really surprised. So I think the problem is people are not looking at it. I talk to stockbrokers and investment planners all the time. Nobody seems to be alarmed by it. So when are they going to become alarmed? Next year when they file their taxes and they've got new taxes they never thought of. That's our concern, Tom, is the surprise.
And of course, we want our informed friends and listeners and clients to not have those surprises, right? We want them to know ahead of time how it can impact them and what things they can do to minimize that.
Well, this law is already passed. We're talking about what you earned in 2013.
Right.
So it's pretty tough to change it now. So we're hoping, as we look ahead, that I think people will become much more interested in this topic next spring.
Okay. Can we talk about some areas where we can minimize the future impact?
Yeah, we sure do. The one that sticks out for most of us when we look at this is muni bond income. Muni bond income or IRA income will not be taxed in this category. So we do encourage you, if muni bonds are something you're interested in, that you might talk to one of your professionals about it, because that's, they don't earn very much money, but they're a pretty safe investment for most people. Maximize retirement contributions and income. Some of the more exotic things that we're looking at with some of our clients are charitable remainder trust, family limited partnerships, gifting. A lot of people don't realize under the new tax laws. I mean, we had major tax law changes this year. Not only Obamacare, but the president signed a new tax bill in January 13, that allowed your annual lifetime gifts up to $5 million. So we're encouraging our clients to look at gifting and, of course, the 529 plan. So, there's a lot of new law, more than I think I've ever seen in 1 year. When you look at it, we all survived the fiscal cliff, but we're now facing new tax laws, and so we're very concerned about that.
Okay. You mentioned to me just before program something about sometimes it might be better to pay the penalty than pay for their insurance. Can you talk about that?
It's interesting. There's so much going on with Obamacare and the covered California and, all the problems across the nation with people. And the younger people, you've probably heard that the government really needs about, 2.5 million young individuals to sign up for Obamacare and start paying their premiums. But when they look at their premiums, like my son, who's in his 30s, so, he looks at the cost of those premiums and says, I think I'll pay the premium. The premium is not too bad. The premium is 1% of the household income. well, that's not extreme penalty for 2014. Again, we're talking 2014. But the next year it goes to 2% of the family income. And then in 2016 it goes to 2.5% of the family income. Still, a lot of people may choose not to have medical insurance. The situation becomes that, we sit and talk to our clients. There's so much confusion about the premiums and Medicare and what do you get and why are my premiums escalating, that you need help. You truly need to help. And so, we encourage you to get with your individual advisors and talk to them about Medicare premiums. I'm sorry, I didn't see Medicare, the Obamacare premiums, and take a look at those. And so a lot of people will pay the penalties rather than that. But interesting enough, the penalty will be added to your tax return. So the government's going to get their money. So that's the concern we have. So starting next year, we're going to have to ask every individual to prove they have health insurance premiums paid. So this ought to be interesting, and the IRS will be in there.
So basically, the IRS is the agency or the avenue for them to collect the money for this particular program.
Absolutely, absolutely. So that's another challenge for the IRS, of course, and we expect more difficulty with that. But we look at it from our point of position is that we're going to have to ask the clients to prove if they have health insurance premiums paid, to prove those premiums.
And so what will they do? Just need to provide the receipt or the check that paid
Tom,
for it?
It's not clear, and it's next year's problem. We got to deal with this year's problems now, but that'll be next year's challenge for us. But the IRS is an interesting position. If someone owes money, they do not have the ability to enforce collection. If you've got a refund coming, they can take the penalty away from your refund, but they don't have the power to collect beyond that refund situation. So if you end up owing, like many self-employed will, they can't collect it. So this ought to be a true struggle that we're facing.
And as you've indicated, if it's cheaper for people to pay the penalty than to do the insurance, and they don't collect the funds to fund this program, then we're off to a tough start. And in addition to the fact that their subscribership is much below what they'd anticipate at this stage of the game.
Absolutely. It's a problem, and we don't know what the solution is, but hopefully, they can do something to correct because what I'm hearing from my clients who call me, the good news, of course, is the people before who couldn't get insurance, who had pre-existing conditions, can now get insurance. But the biggest problem is premiums have increased substantially.
Good. We have with us today in the studio Richard Smith, who is an enrolled agent. He's been in the tax accounting advice business for 30 years, been an investor for 40 years in real estate. Great to have him with us. When we get back, we're going to, from the break, we're going to talk about ways that you can reduce your tax for this year, and we'll be there and be back with you in just a moment on KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thanks for coming back with us after the break. We have with us in studio today Richard Smith, who is an enrolled agent and talking to us about tax planning. So, Richard, just before the break, we were talking about the Medicare tax and Obamacare, and I think you wanted to add on some comments about other changes in capital gains.
Tom, there's major changes in capital gains, and I'm sure some of us remember the discussion about a year ago that Mr. Obama wanted to raise tax rates on the wealthy individual. Well, he was able to do that. Wealthy is a relative term, but they have a new tax bracket, and it's a new 40% tax bracket disguised as the real 39.6. 40 sounds so menacing, they made it 39.6. Now, this bracket is for individuals, single taxable incomes above $400,000 and married couples with taxable incomes above $450,000. A lot of our clients and a lot of people we know in Silicon Valley, because they have capital gains and stock options, fall into this new tax bracket. So, new tax bracket, 40%. California also has a brand new tax bracket. We passed Prop 30 last year that raised the tax brackets again for people making over $450,000. And it was retroactive last year back to January, so a lot of people got trapped on that because they'd already withheld the money for an option that they had exercised earlier in the year. So now we're talking 40% federal, approximately 10 to 12% California, depending on your income. And then you also got to pay your Social Security rate, another 7%. So sounds pretty menacing for people. So capital gains rate, again, we're talking the rates have increased from 15% to 20% for sales of long-term assets. This would be real estate and stocks that you've owned for more than a year. So now the new rate on those is 20% for that amount that exceeds those levels of 400 and 450. So
that begins when?
It starts at 400,000.
No, I mean which time?
Oh, that
year?
Starts for this year. I'm sorry.
This
2013.
2013
starts for 2013, and so we have a lot of people now that they're looking at the stock market trying to decide what they're going to do. So you got to look carefully at the capital gains on your long-term assets that you've held, because it may cost you more than you thought.
So one defense you might have, I guess, is to if you're going to sell a certain amount of assets, you might want to split it between 2 years if that keeps you under the threshold to move up to the higher level. Huh?
It can be significant, Tom. We had a client who was trying to decide if he was going to sell his home. Of course, married couple, the first $500,000 is not taxed. Its profit is tax-free, but they had decided to wait and sold the property this year rather than last year. Additional tax was $40,000. Of course, hopefully they made more money on it. So it's always tough when people come in, and people are talking about selling their homes in Silicon Valley, and they've got large profits. Even though $500,000 is tax-free for married and $250,000 single, we see large amounts of people selling for much more than that. And of course, that forces both the taxable income and the capital gains rates to increase. So, be careful if you're selling. And year end is when a lot of people do think about selling, of course.
Yeah, it's one of the problems we certainly have in these coastal cities in California, isn't it? A lot of laws are made with the general country in mind, but if you're in a high-end coastal city, we can get some significant impact because of the prices of our real estate. Let's for our next break, let's hit on a few kinds of expenses that people could deduct or take that maybe they haven't considered, such as job hunting and so forth. Let's talk about a few of those. We got about a minute in this segment.
We have a lot of people come to see us this time of the year that want to reduce their taxes at year end. What can we do? We've got a lot of these on our website, richardsmithtax.com, the things that you might consider more at year end than any other time of the year. But the key is to determine, what is your tax bracket? What are your potential taxes if you have them? Because if you fall into that dreadful alternative minimum tax, then you may not be able to use a lot of normal kinds of year-end tax planning that you might consider. So you got to determine what your position is. Also, what's my income this year versus next year? What would be the best? But normally we say defer income and take deductions this year. But again, determine if you're an AMT or alternative minimum tax, and what's your position for next year. But always we tell people defer, defer, defer. If you can defer rental income or capital gains or anything you can, always push it into next year, the year of the unknown, rather than face those taxes this year.
So let's get into some of those details as soon as we get back from the break, so people have some specific examples of things they can actually do to reduce their tax this year and be planning for next year, so they aren't in a panic in December. So we have with us in studio today Richard Smith, very experienced real estate investor and tax advisor and accountant and enrolled agent. We'll be right back on KDOW 1220 AM, the Wall Street Business Network. This is Real Estate 360.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thanks for being back with us with a very important subject today. Even though it may be dreadful, it's a very important one to know because it can save you a lot of money. We have Richard Smith with us in studio, who's a very experienced real estate investor as well as tax advisor and accountant. and been mine for a long time. It's we're talking about ways to defer tax or reduce taxes for this year. Let's get into the meat of some of those. Let's give some examples of things that people can deduct that maybe they didn't think about, and maybe we should start off with when does a credit card charge and a check charge, when does it count?
Tom, I'm talking to a lot of people this time of the year. How can I reduce my taxes? I know they're in trouble, and they're looking around to see what they can do, reduce them, and that's what we're here for. And the point I always make to my clients, I probably got more ways to save you money than you've got money. Okay, people have a situation of how am I going to, I've got a list here of 40 items in front of me, and if you go to our website, richardsmithtax.com, and sign up for our tax newsletter, our monthly tax newsletter, you can see these 40 displayed on our website. But the thing is, where do you get the money to do some of these items that we're going to suggest to you? And so we look for ways that we can produce income for you to take advantage of some of our deductions. So let's deal with a couple of those. But number one on my list, recall, please, that when you use a credit card to pay for an item that you're going to deduct on your tax return, you don't have to pay for it until that credit card comes due. And then even if you're a person who is not able to pay it immediately, but at least you can get 30 days out before you have to pay for it. And a lot of people are deferring income from bonuses and commissions, and they're deferring that income. Their companies will allow them to defer it into January. Then they can pay the credit card that they've bundled up with some of these deductions we're going to share with you today.
But the date of the credit card charge is when you get to claim it against your tax return,
that's
right?
Correct. That's correct.
Even though you don't have to put that cash out of your pocket yet.
Correct.
So that's important.
That's my favorite deduction. Now, if you're writing a check, then of course the date of the check that counts, or the date of the receipt that you have. So, those are more real and current and timely. But
on the other hand, if someone writes you a check, it's when you deposit it, right?
Exactly. Mm-hmm. So when you talk about rental income, Tom and I both have rental properties that we have. Well, maybe we're on vacation that last 2 weeks of the year, and those checks didn't get deposited. So the IRS may frown upon you, but they look to your bank deposit as the date you have to claim the income. So when you defer income from your employer or your self-employment, I have clients right now, they're taking the last 2 weeks of the year off, and they're out of the country, and so that date of deposit becomes the date of income. Unless it's a W-2 or a 1099, then you're stuck with those items that are on those two documents.
Okay, let's go into some examples.
My favorite deduction this time of the year is I have clients come to me and they've got funds available. They owe taxes, and normally if a person owes one, they owe the other. So they owe IRS, they owe California. What should I do? We always advise them with limits. They might consider prepaying California first. So you make a check to California dated December 31st. We're not sure when you mail it, but the check is dated December 31st. You can deduct that amount of money dollar for dollar against your California liability. Great. Number two, you can also deduct as an itemized deduction on your federal tax return on Schedule A, your itemized deduction. So you're getting a bonus for that. You get another 20 or 30% savings of that amount. Again, if you're an AMT, alternative minimum tax, don't ever do this, because that deduction is not deductible on AMT. So, that's where you have to make the decision and do a little more planning to determine if you're an AMT. But that's the one that most people face. What do I do about outstanding liabilities? Can I avoid penalties by paying this year? Yes, you can.
Okay, that's great. We'll get more examples like this in just a moment. So stick with us. We have Richard Smith here in the studio with us, an experienced real estate investor and accountant. And this is Real Estate 360. On KDOW AM 1220, the Wall Street Business Network. We'll be right back. Don't go away.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back in studio today, Richard Smith, experienced real estate investor and accountant, helping us do some tax planning. Richard, let's continue on giving our listeners some great examples of things they can actually concretely do, the nuts and bolts of what they can do to help their tax situation.
Tom, I've got what I call my top 10. And if you get a chance to go to our website, Richard Smith Tax, you can see that. But the second one that I like the most, besides the prepayment of California tax, is prepayment of your January house payment. Remember, your January house payment that you make in early January is for December's interest. If you date that check December 31st, you get 13 months of interest this year. Not bad. And, the question is, when did you mail it? Remember, it's the day of the check that counts. The only thing you have to remember is your statement that you get, your 1098, will not include that payment. So you got to add that on to it. But great deduction. You're going to pay it anyway. In this case, maybe you pay it a few days early and you get a couple, $2,000 or $3,000 worth of deduction that you would have paid anyway. So what a great deduction. Along with that, the other one we like is to prepay your April property taxes on all your rentals, all your residences that you have. Because remember, that payment of property taxes is due next April. You just received it from your county and it's got both coupons there. So I always mail off both coupons at year end. I'm too busy on April 10th to even think about property taxes, so it's a great way to go, and you can do the same thing with your with all your rental properties. The other one I like is that you can sell stocks. Again, a way to produce money to take advantage of some of our other deductions. So you sell a stock at a loss. The maximum loss you can take on your tax return is $3,000. So you're allowed losses in excess of gains up to $3,000. But the sale of those stocks gives you more money to do some of these other things, like fund your IRAs and fund your pensions and do all these other things that we have on our list. So selling stocks for a loss. I have clients who do it every year, and so it's a matter of working with your financial planner people and deciding if that works for you. Some others I like a lot are you can use your automobile for charitable miles, working with your churches and charities and helping people at your end. What a great thing to do. Deduct a charity miles deduction. It's different between federal and state. Runs about 20 cents a mile, so it's a great deduction. Also, don't forget when we talk about charitable deductions, the non-cash. I always encourage my clients, we're talking Goodwill, Salvation Army, Hope, those kinds of organizations. Take the stuff out of your garage and your kids' closets, wheel it down there to make room for the new stuff you're bringing in for them. So it's a great, great deduction.
Talk about above and below $500 line. What the significance is of that?
Well, if your itemized deductions of those non-cash that you're giving, if the fair market value exceeds $500, you have to attach a new form, 8283. You have to list the condition and the value of it. But, a lot of people do that. One of my favorite stories I always tell my clients is when Bill Clinton released his tax return when he was running for president, he deducted his underwear and long johns on his tax return as non-cash donations. That always sticks in my mind, saying there's more opportunities than people realize out there. I truly admire him for doing that.
Well, so many people think, oh gosh, these wealthy folks must be cheating, and in general, that's not the reason they get lower taxes, because they're doing things that they know that the government encourages them to do, right?
The government encourages you to give both donate. It's kind of a sacred deduction. There are two. We hear all this conversation about what they're going to do about tax reform. Of course, we're not going to have tax reform for a little while. But
Steve Forbes flat tax probably won't happen.
I don't see that. There is a tax reform committee in Congress, and we keep reading reports from them. But still, it comes down to some deductions that are pretty sacred. One is charities, Tom. Think about it. I mean, it's a tremendous deduction, and it helps so many people. Year end's a great time to help people.
Who would be crazy enough to vote against that, right? Yeah.
Well, I don't think we're going to see it go away. It may be bundled someday, and it may have a limit. There's so many different strategies. It's hard for Congress to get their arms around which of these national organizations do they want to offend. Yeah, is it the Association of Realtors, the mortgage brokers, or the charitable Catholic Church? Which one would you like to offend first?
Yeah, in our capitalistic society and private industry and free markets, what a wonderful way to redistribute wealth, isn't it? Huh?
Absolutely. Yeah. I would go for a flat tax tomorrow. It would help a lot of us, but most people, they're more worried about their mortgage deduction.
I spoke to Steve Forbes at the Freedom Fest earlier this year and chatted with him about that, and he still seemed to be about as gung-ho as he always was, and thinking that eventually he can get flat tax through.
Well, we redo taxes every year. The way I look at it, they design it the way they want it. Congress decides what they want to be in favor of each year.
Sure.
The other deductions I like are the prepayments. Tom and I talked for a minute about prepayment. There's lots and lots of things you can prepay. The one I like to do is travel expenses for next year. In other words, I'm going to go to a convention. I'm trying to find one in Maui right now so I can write that off. So I can prepay for my airfare, my hotel, my rental car, And I can write those checks now. I can write those on my credit card.
Oh, that's right. It's when you buy your plane tickets, not when you fly, huh?
That's correct. So prepayment for business travel next year is a great one. The one that Tom and I talked for a minute, he hinted at was job hunting expenses. Probably my favorite year-end deduction, because remember, you have to go job hunting for the same kind of job you have now, but you don't have to change jobs. So I have people planning their job hunting trips right now. So we say, well, let's decide we're going to go Maui job hunting at year end. If you're going to do that, and I have people that are doing it, please set up some interviews, locate a headhunter over there that can set up some. You actually have to interview.
Yeah.
So
it's got to be real.
It's got to be real. You only have to hunt for half a day though. The other half you can go to the beach and snorkel. So prepayment of job hunting.
And in our we're all so happy that Silicon Valley is doing relatively well coming out of this economy, but you and I both know lots of folks have been looking for jobs still for a couple of years, and so job hunting is still something that's important to a lot of people. Yeah.
You know what I find when people go job hunting, sometimes they find a job. That's what I think. They weren't thinking about it, but that happens all the time. That's what's happening in Silicon Valley. There are a lot of jobs available. During the holidays, some of these companies are shut down. One of my other favorite is, we all think about things that we can buy for our businesses at year end. Also think about taking your car in to have your car serviced so you get an odometer reading in case you need that later. But, you can tires and tune-ups and brakes and batteries and, all those things that need to be done. Detailing your car. I mean, it's just, if your car is your business tool, then you need to take care of it this time of the year. So we also said you can pay your children and your spouse for helping you in your rental or your business. My favorite, I guess they're all favorite when I think about it, Tom. But paying your children and spouse, what a great way.
You all need to have an accountant who gets excited about saving you money. So that's why one of the many reasons I love Richard, and so glad to have him in the studio here today. We'll be back in just a moment for a wrap-up here on Real Estate 360 KDOW 1220 AM, Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Oh, what a great program it's been today. I hope all of you listeners have gotten a few tips, something that'll save you some money. It's great having Richard Smith with us today. We, I was had some time with Tom Wheelwright, who's Robert Kiyosaki's advisor on tax last year and the year before that. And one thing that he often promotes and says that people don't realize, I think, is that he says that the tax code is not something to be afraid of. He said about 5% of it tells about how they're going to collect money. 95% of the tax code is telling you how to reduce your taxes and all the things that you can invest in and all the things that you can deduct that will help mitigate that potential tax burden. And I think most people don't think of it in those terms. So you should, the more you learn about it, the more you get a very experienced and excellent advisor and accountant like Richard Smith, the better chance you have of keeping more money in your pocket.
Tom, we had an interesting year. Thank you for having me on today. And lots of new tax laws, lots of new opportunities, the way I look at it. But you have to put a little time into it. You can't just prepare for your tax return every year and ignore it the rest of the year. When I saw these new laws coming forward, I sent letters to my clients, encouraged them to do planning. And I think the people who plan do save taxes. I think you have to spend a certain amount of time every year in tax planning, more than you spend on planning your vacation is what we always say. But the situation is that taxes are going to continue to increase. We see that with Obamacare, new Medicare taxes. And incomes are increasing. So, the point is that you've got to defend yourself and you've got to be aggressive. We encourage you to go to our website and sign up and look at the other year-end tax strategies we offer you. We don't solicit any of those clients. We don't sell your names. We have a monthly tax newsletter that goes out. And I'm sure it'll help you save some taxes. But new taxes, new opportunities, the way I look at it. So please, take a look and give me an email. send me a phone call, something, so we can respond for you.
How can they reach you, Richard?
Well, the easiest way is email, of course, and my email is richard@richardsmithtax.com. This time of the year, it's wild and crazy. We're trying to get prepared for the upcoming tax season, so that's the best way. You can try a phone call at 408-446-5551. Email is easier and better, and I guarantee you we'll get back to you.
And if you just go to TomWilsonProperties.com and would like to get copies of some of these notes, we'll be glad to get that to you or get you a referral in there to Richard. It's also, remember, if you want to have a one-minute read once a week, we have a weekly economics newsletter as it applies to real estate that's written by an economist and friend of ours. And that's you can sign up for that, no obligation. Your name doesn't go anywhere else. Also, we have a report on how to select the best metro and how to select the best property for a 19-page fact-based report that helps you make that decision. And we're glad to provide free consulting for you for helping you take a look at your real estate portfolio and ways that you might be able to leverage that a little bit higher. So, again, great having Richard Smith, our 40-year investor and 30-year tax advisor and accountant, with us today. It's been great having you. Thanks for all the tips and things that we can all use. This is KDOW 1220 AM and on the Wall Street Business Network. And remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360. For more information on today's program, visit RE360radio.com. That's RE360radio.com.